Welcome to our estate planning series for blended families. Blended families are built on love, resilience, and a unique tapestry of relationships. But when it comes to estate planning, these beautiful complexities can bring unique challenges. How do you balance the needs of your spouse, children, stepchildren, and other loved ones, while minimizing financial stress and ensuring harmony? In this video, we'll explore how to navigate the often tricky waters of estate taxes, inheritance planning, and financial security for blended families. Whether you're wondering how to structure a trust, protect your children's inheritance, or minimize tax burdens, you're in the right place. Imagine this: a future where every member of your family feels valued and protected, where your legacy is honored, and financial conflicts are a thing of the past. It's possible, and we're here to show you how. Let's dive in and take the first step toward creating a secure, thoughtful, and inspiring plan for your family's future. You've got this, and we're here to help. Overview of estate and inheritance taxes. Estate planning for blended families involves careful consideration of estate and inheritance taxes, which can have a significant impact on the distribution of assets to beneficiaries. Understanding these taxes and their implications is crucial for ensuring that your loved ones receive the intended benefits of your estate plan. Estate taxes. Estate taxes are imposed on the total value of a deceased person's estate before it is distributed to beneficiaries. The federal government and some states levy estate taxes, and the tax rates and exemption amounts can vary widely. For example, as of 2021, the federal estate tax exemption is $11.7 million per individual, meaning that estates valued below this amount are not subject to federal estate tax. However, estates exceeding this threshold may be subject to a tax rate of up to 40%. In the context of blended families, estate taxes can complicate matters, especially if there are children from previous marriages involved. Proper estate planning can help minimize the impact of estate taxes on the transfer of assets to ensure that all beneficiaries are provided for equitably. Inheritance taxes. In addition to estate taxes, some states impose inheritance taxes on the beneficiaries who receive assets from a deceased individual's estate. Unlike estate taxes, which are levied on the estate itself, inheritance taxes are imposed on the beneficiaries based on the value of the assets they inherit. The tax rates and exemptions for inheritance taxes vary by state, so it is essential to be aware of the specific rules in your state. Blended families may face additional complexities with inheritance taxes, particularly if there are stepchildren or non-relatives among the beneficiaries. In some states, stepchildren may be subject to higher inheritance tax rates than biological or adopted children, highlighting the importance of thoughtful estate planning to minimize tax liabilities and ensure fair treatment of all beneficiaries. Strategies to minimize tax liabilities. There are several strategies that blended families can employ to minimize estate and inheritance tax liabilities, including 1. Establishing trusts. Trusts can help reduce estate tax exposure by allowing assets to pass outside of the probate process and providing greater control over how and when beneficiaries receive their inheritance. 2. Gifting assets. Making gifts during your lifetime can help reduce the size of your taxable estate, potentially lowering estate tax liabilities for your heirs. 3. Utilizing marital deduction. Married couples can take advantage of the unlimited marital deduction to transfer assets to a surviving spouse tax-free, deferring estate tax liabilities until the second spouse passes away. 4. Seeking professional advice. Consulting with estate planning professionals, such as attorneys and financial advisors, can help you develop a comprehensive plan that takes into account your unique family circumstances and goals. By understanding the nuances of estate and inheritance taxes and implementing effective planning strategies, blended families can navigate the complexities of transferring wealth to future generations while minimizing tax liabilities and ensuring fair treatment of all beneficiaries. Strategies for minimizing tax liabilities in estate planning for blended families. Estate planning for blended families can present unique challenges, particularly when it comes to tax liabilities. However, there are several strategies that can help minimize these tax burdens and ensure that your assets are distributed according to your wishes. Below are some key strategies to consider. Utilize the unified credit. The unified credit, also known as the estate tax exemption, allows individuals to pass a certain amount of assets to their heirs tax-free. For blended families, it's important to maximize the use of this credit by properly structuring your estate plan to take full advantage of the exemption amount. 2. Establish trusts. Trusts can be a valuable tool in estate planning for blended families. By setting up trusts, you can control how and when your assets are distributed to your beneficiaries, which can help minimize tax liabilities. Trusts can also provide asset protection and ensure that your assets are used in accordance with your wishes. 3. Consider lifetime gifts. Making gifts during your lifetime can be an effective way to reduce your taxable estate. By gifting assets to your heirs, you can lower the overall value of your estate and potentially reduce the tax burden on your beneficiaries. Just be mindful of gift tax rules and limitations. 4. Use qualified retirement accounts. For blended families, it's important to carefully consider how to designate beneficiaries for your retirement accounts. By properly designating beneficiaries and utilizing strategies like stretch IRAs, you can minimize tax liabilities and ensure that your retirement assets are distributed according to your wishes. 5. Take advantage of step-up in basis. When assets are inherited, they receive a step-up in basis to their current market value, which can help reduce capital gains taxes when the assets are eventually sold. By strategically planning asset transfers within your blended family, you can take advantage of this step-up in basis and minimize tax liabilities for your heirs. 6. Work with a professional. Estate planning for blended families can be complex, especially when it comes to tax implications. It's important to work with a qualified estate planning attorney or financial advisor who has experience in navigating the unique challenges faced by blended families. They can help you develop a comprehensive plan that minimizes tax liabilities and ensures that your wishes are carried out effectively. By implementing these strategies and working with a professional, you can create an estate plan that minimizes tax liabilities for your blended family and provides for the financial security of your loved ones. Financial planning tips for blended families to ensure a secure future. Blended families, which consist of individuals who have remarried and have children from previous relationships, often face unique financial challenges when it comes to estate planning. To ensure a secure future for all family members, it is crucial for blended families to engage in thoughtful financial planning. Below are some essential tips to help blended families navigate these challenges. Open communication. The key to successful financial planning in a blended family is open and honest communication. It is important for all family members, including both spouses and children from previous relationships, to have discussions about their financial goals, expectations, and concerns. By understanding each other's perspectives, families can work together to create a comprehensive financial plan that meets everyone's needs. 2. Update wills and estate plans. One of the first steps in financial planning for blended families is to update wills and estate plans. This includes clearly outlining how assets will be distributed among spouses, children from previous relationships, and any new children that may have been born from the current marriage. Working with a qualified estate planning attorney can help ensure that the wishes of the blended family are properly documented and legally binding. 3. Consider a trust. Establishing a trust can be a helpful tool for blended families to protect assets and ensure that they are distributed according to the family's wishes. A trust can provide flexibility in determining how and when assets are distributed, as well as protect assets from creditors and potential disputes among family members. 4. Review beneficiary designations. It is important for blended families to review and update beneficiary designations on retirement accounts, life insurance policies, and other financial accounts. Failing to update these designations can result in assets being distributed in a manner that may not align with the family's wishes. 5. Plan for education expenses. Blended families may have children of different ages who are at various stages of their education. Financial planning should take into account the costs associated with education, including college tuition and other expenses. Setting up education savings accounts or trusts can help ensure that all children have access to the resources they need to further their education. 6. Create a financial safety net. Blended families should also consider creating a financial safety net to protect against unexpected events, such as job loss, disability, or illness. This may involve establishing an emergency fund, purchasing adequate insurance coverage, and developing a plan for managing financial challenges that may arise. By following these financial planning tips, blended families can work towards creating a secure future for all family members and ensure that their wishes are carried out in a thoughtful and comprehensive manner. Consulting with financial advisors and estate planning professionals can provide further guidance and support in navigating the complexities of financial planning for blended families. Your legacy, their future. Estate planning for a blended family isn't just about documents and numbers. It's about love, fairness, and leaving a legacy that reflects the care you have for every member of your family. By understanding tax implications, strategically minimizing financial burdens, and making thoughtful decisions, you're not just protecting assets, you're preserving relationships and ensuring harmony for generations to come. Imagine this: a future where your family thrives together, where your spouse and children, biological and step alike, feel equally valued and supported. With careful planning, you can create a legacy of unity, stability, and love that will be remembered long after you're gone. This journey may seem complex, but it's a testament to the depth of your commitment to those you care about. By taking these steps today, you're gifting your family the security of knowing their future is cared for, their needs are understood, and their relationships are respected. It's never too early, and it's never too late to craft an estate plan that speaks to your family's unique story. Take the next step, because peace of mind and a brighter tomorrow for your loved ones is worth every effort. You've got this, and your family's future will thank you.